Welcome back, everybody. This is Rodrigo Fonador with another episode of Asheville Real Estate News. As a reminder, our episode today and all of our episodes here are brought to you by American IRA LLC. They're a local IRA custodian here in the Asheville area. So if you have any questions about self-directed accounts, retirement accounts, etc., always encourage you guys to reach out to them. Today, we are talking about something you can actually use your IRA accounts with and for, potentially. We'll get some clarification on that, but today we're talking about multifamily investing. Maybe we'll dip into some syndication, and we'll see where else this conversation goes. Personally, don't know too much about multifamily, so always excited to explore topics that are new. So, Bill Zahller with Park Capitals, welcome to the show.
Great, thanks, Rodrigo.
Yeah. Here. Kind of as I referenced, we're going to talk multifamily. I was hoping you could give us a quick 30-second definition of what multifamily is to just kind of lay the groundwork for everything else.
Sure, absolutely. Of course, anything with more than one unit. So the 2 to 4 is typically still considered residential for loan purposes. So basically, the commercial side of it is 5 units and up. You get into different kind of matrix for measuring it versus the comp sales comps in the area. It's more based on the net operating income valuations. Is how the value on properties 5 and larger. And then within that, there's certain, of course, economies of scale. So we look for 100 unit plus deals at that point. Typically, 50 units per person, you can add somebody. So at 100 units, you can have an office manager and a maintenance person on staff, which just makes things smoother.
So every 50 units, it's basically an additional staff person.
Exactly.
Okay.
300 unit building, you probably have 3 in, 3 out.
Okay, cool. I hadn't heard that before. So it's
just
again, I don't know much about multifamily. So anyways, but before we even delve in too much into the real estate side of things, do you mind kind of sharing with us a little bit about your background, your story, how you got into real estate, how you got to Asheville, et cetera?
Sure, absolutely. Grew up mainly in Northwest Ohio.
Okay.
Moved around a lot. My father is a pilot, and I actually got into flying also.
Oh, awesome.
A commercial pilot. Been doing that 25 years for a large fractional ownership group. And then probably 14, 15 years ago, I was living out in Scottsdale, Arizona at the time, and got into real estate investing in single-family homes back there. Enjoyed that, really, I guess got the bug.
Yeah.
And, really enjoyed, got a good experience and lesson from that. And then as I had some friends who lived here, moved to Asheville from Scottsdale, would come and visit them in the summers and
get away from the sun.
Exactly, yeah, great time to come to Asheville out of Phoenix anyhow. And really enjoyed it. So just ended up moving here maybe probably 9-10 years ago.
Okay, so I got here in 2009, so it's probably very similar time frame.
Right.
Yeah.
Absolutely. And I've really, like I said, love Asheville and not planning on going anywhere. So, and then the multifamily side, at some point, if you start doing the math, the scalability, it just makes more sense. The numbers get much larger, the deals, and you get, like I said, just basically the scale. I mean, you can't manage 1,000 single-family units. I mean, that's a lot of logistics.
Yeah, no, I understand. We don't have anywhere close to 1,000, obviously, but first started, it was like, 1 is easy, 2 is not too bad, 3, and then you're like, man, there's a lot of paperwork, and then it's nice when we got Nolan and he manages all of our rentals jointly, and that's been such a that transition was really fun to breathe a little bit, focus on other things and whatnot. So
absolutely, you get distracted, and if your job is to find deals, and you have to in the day to day, just the operation of it, you lose focus. And
and it's just as important, right? Like good books is just as important as a good deal. So. Yeah. So when did you actually make that transition, and was there a tipping point to go from single family to multifamily?
No, I started educating myself, I guess, on the multifamily space. Did a lot of research maybe 4 years ago. Okay. And trying to find out who was doing what I wanted to do. I do a lot of reading and books and podcasts and that nature, and always been like a Tony Robbins fan, and the further faster.
Yeah. Huge. I went to a total side topic here, but went to Unleash the Power Within maybe 5 years ago, and that was a huge mind-boggling, mind-opening experience. It was really, really powerful for me. So yeah, I can relate.
That's actually one of my mentors is a huge Tony Robbins. He's been to several of his live events also.
Yeah.
And that's basically where, so versus,
Right.
having to reinvent the wheel, find out somebody's doing what you want to do at a high level. And,
Break it down.
Copy it. Yeah. I mean,
Yeah.
so that was basically, so I started looking for somebody that was doing multifamily investing, syndication, having success at it. And in this case, the gentleman had a similar background. We had a professional background. Like I said, I'm a pilot by training, and then also he was a sales executive in New York, or advertising. So, in transition, he had 4 single family homes, and today he has over $500 million in in multifamily, in less than 5 years.
Yeah.
So, I mean, the scalability and what he's done is pretty amazing. So,
Yeah, actually, I don't know if you're allowed to share your mentor's name or whatnot, but I was reading a book, and they actually referenced this story, and I found it, and it was like 2 days ago. And I was like, oh, that's so funny that it lined up, because I knew we were going to be talking this, because that's really interesting. So, but yeah, if you want to mention who it is, feel free. If not, you don't have to. But yeah, so you got plugged in 4 years ago with
Joe Fairless.
So great podcast too. Now we
absolutely. Yeah, he does a daily real estate podcast. Been a great resource. He's on our advisory board also. So just for the the high level kind of guidance on growing some of that, he's been invaluable. Yeah, great guy to work with. I actually was out at his conference in February in Denver. Got to speak out there on the panel. So yeah, great exposure also to the same group of people we're looking for. And,
yeah, no doubt. Yeah. So when you got into it 5 years ago or 4 years ago, are you guys doing the same model then, or I don't know if you're able to kind of break down kind of your all's approach and business model to multifamily?
Absolutely. It is the same model that Joe kind of has. So we look for value add deals. I mean, versus there's core plus, value add, and then total rehabs.
Right.
So we're not the heavy, where it is on the risk scale, we kind of seem that, there's less risk, obviously the core, but the returns are less. There's higher returns, but much more risk we see in the, either ground up development or total reposition of a property. So we like to be, we think we're kind of the best blend of both. Where the value, you can force the appreciation is the concept that the value add we focus on. So we buy stabilized assets from day one. So, and the stabilized definition is 90% occupied within the last 90 days for any kind of agency, FEDI, or for any debt that require that to hit that threshold. If it's below that, you're going to have to do some kind of bridge program. So to get agency debt from the beginning, we want, and that's your lowest rates, your fixed, it's non-recourse. Yeah, it's everything you want in a loan.
In a loan,
right? Exactly. So especially for those size deals. And on that, the value add strategy is basically if we can find a product that hasn't been renovated, say, in 10, 15 years, we look for like 1980 to 2005 kind of time frame, which will put it usually in a B area, maybe B plus area. And so we want to find something that the comps around the area that are $150, $200 higher for renovated units. And then so they've kind of proven the strategy. And if they've maybe done 10% of the units themselves, and that gives us, again, they've proven the model. Yeah. And we can just continue the renovations from there. And it's easy to plan out your capital improvements and
Yeah, no, it makes sense. But for anybody who doesn't know, do you mind breaking down? You kind of referenced what the rating system is. You said B+ area. So what do you mean, and what other letters do we need to know?
Absolutely. It's broken down to there's the general area is broken down on a scale of letter scale A through D, right, and then the property type also is broken down like A through D. A is going to be your brand new communities in the best part of town, the best amenities, all that. B was probably that 15 years ago, and it slides down to B as the new stuff's built, new amenities, newer locations, that kind of thing, or they come online. So B is a great place to play in, and then C is kind of your workforce housing. That can be good too. It's a slightly different model. But B and C are probably the most stable, I think, because on the high end you have the A's, and if there's where you find the overbuilding, the competition. When it's doing great, all the developer builds Class A, and then they're giving concessions, they're giving 2, 3, 4 months off, and so you get a lot of. And when there is a recession or as it
flattening of the market,
exactly, it's going to hit there first. The people that they'll leave the A+ building and may not want to pay $2,000 a month, but they're not going down to C- or D. Right,
they're going to be in that B to C range or whatever.
They're still comfortable in that product, and it's just a nice clean product. And then D is war zones.
Try to stay away from that.
Exactly. You don't, unless it's your specialty, you don't want any part of that.
And I'm sure there's people that focus on that and niche in that, right?
Right.
Yeah.
And most of that it's purely, and of course the returns, it's all based off that. Because the risk reward, right? Like in anything, the A is going to have a much lower return on that. The D's will be much higher. But there'll be no appreciation pretty much in
Right.
the deed. They're basically going toward obsolescence. They'll be demolished at some point, and they're functionally obsolete at this point. They're probably 40 years old. Bad parts of town. There's just really nothing going for them other than people seeing they look like price per door is cheap.
Yeah.
The yields,
High.
12%, but there's a reason, right?
Fair enough. How hard is it to take a C to a B or a B to an A? Quote unquote, change the the rating for them. Is that something people do? Is it possible, or is it?
Absolutely, and it's a great strategy. But what you need to be careful of is you can take the building itself. So what you ideally would look for, you want to find like a B area, and say you find a C plus asset, and then you can improve that asset to a B. Which is harder to do is have a C area and have a B asset. You can't improve the entire neighborhood, so you kind of get limited out.
So you have to be in a neighborhood that's going to support where you want to go to begin with.
Yeah.
That makes sense.
Yeah, because you'll find like some of the, and one of the key things we look at not only in jobs in the area, but we look like also medium household income in like the 1, 3, and 5 mile ranges.
Okay.
So if you're looking at something that, $30,000, the medium household income, it's not going to support
$2,000 a month.
Yeah, exactly right.
Yeah.
So you're looking, you're going to be looking more like the $60,000 to $100,000. That's the upper end is going to be like your A minus, B plus. They'll want the granite, they'll want the stainless steel, they'll want the newest amenities. That kind of thing. So you've got to make sure you don't over-improve. You can easily over-improve a property, and it looks great, but no one can afford to live there. So
then it kind of defeats the purpose.
Right.
So, just kind of listening to you talk this through, it sounds like you guys are really data-driven. I know sometimes some of the stuff that you buy single family, I don't know anywhere else, but at least here in Asheville, it's like a little bit of a gut feel oftentimes where you're like, well, I think this makes sense. And then, based on experience and what you've seen, how much of what you all do is gut versus just like driven data that you can kind of count on and take the total emotion out of it?
Right, absolutely. We're very data driven, but we're also, it's an art and a science kind of thing. So the numbers have to make sense. So we'll get a deal in, we'll do the underwriting, the trailing 12 financials, so we'll run those, run the rent roll, we'll put the model in. If it makes sense, then we'll go to the next step, we'll schedule a tour. And you get a lot of you get a feel for it too.
Right.
Like you see a beautiful property online, the broker's made it look beautiful, and you get there and you drive down the road and you're like, there's trash, it's just a bad.
I'm gonna just keep driving.
Exactly. Well, so you learn a lot from that. But the more you tour, the more you'll have that gut feeling of like, okay, we've seen this before. The neighborhood's nice. We can turn this property around.
Right.
Or, so it's a little of both. You definitely want to spend time on there. I would never put an offer in never visiting the property because no matter how well it underwrites, if there's it's next door to something you
can't see
exactly.
Google Maps only takes you so far, right?
Exactly, and traffic problems, or there's a million different reasons why you wouldn't want to do it, but you look at the basic, the job growth. You want to have population growth. You want to have good schools. I mean, there's easy access to major employment centers. There's a lot of things that are constant that you look at in every deal, but then you have to actually get a gut feel when you get there and kind of see if it fits your model and what you're looking to do. Because it may fit somebody else's model, but you have to know what your model is. I'm always talking about don't be, the shiny penny syndrome. Somebody will get, and it's, from real estate, I think we're mostly entrepreneurs anyhow. So you always have that, that's a great idea. And, somebody will do note investing one day, flipping house the next day. So I'm a big believer in dive deep and become an expert.
I think you're telling my story in reverse. When I first 24 months was just total chaos because I was like, every time I went to a meeting or I heard a podcast or I watched a webinar, I was like, oh, I'll do that too.
Exactly.
And I was trying to do a little bit of everything and ended up doing a whole lot of nothing. and it wasn't until I really dialed in where, I started actually gaining traction because of that. I was just all over the place. With multifamily, I've always looked at it. It's intriguing. And then I come up to two things. One is shiny penny syndrome. I'm like, I'm doing something. It makes sense. Why leave that? But B, it's like, man, those are some big numbers. What is barrier to entry? What's the mental jump that you kind of went through to go from buying a $150,000 house to buying $1.5 million apartment complex, or probably more than $1.5 million, I'm guessing. But
our first one was 216 units. It was a little over 12.5 million.
Right.
Yeah.
So I mean, that's a big jump from a house, right?
It is, and there, and I hear it's in the mental part too. Yeah. I'm a big believer in the mental side of it, but there's also real barriers to entry. Right. I mean, you have to have real actual cash to get to the finish line. I mean, you'll get it back at closing, but you still have to be able to front. I think we had.
Sure, it takes money to get through the due diligence period, right?
Absolutely.
Yeah.
We had close to $200,000 hard, I think, by the time we got to closing on that deal. So I mean, we had to be able to front that. So I mean, there are some barriers to entry,
right.
But a lot of it is just the experience of, you underwrite them a lot, you visit them a lot, and you get more comfortable seeing it.
Yeah.
And like I said, it helps having somebody that's doing it currently.
You can
run
follow
ideas
their
by
footsteps,
them.
or yeah,
just run it by. Like, hey, this is our underwriting. Here's what we came up with. Does this make sense to you? Do you see what we're looking at?
Yeah.
And you get a lot of good checks and balances that
right.
way. And especially on the first deal we want to make sure we weren't missing something. You don't know what you don't know sometimes.
Yeah,
so
for sure.
I underwrote it. My business partner Richard underwrote it. We had a key principal was on the deal too. He underwrote it. The debt guy obviously underwrote it, and then I paid a third party out of New York, this professional underwriters, to run it. So that was probably our fifth one or sixth one, to make sure all the numbers came within a fairly close parameter to make sure nobody's missing anything, and just a peace of mind, from it was well worth it. And,
I'm sure just knowing that, like, okay, we didn't miss anything at least, right? Yeah,
right.
So do you all do syndication? Is that how you guys fund?
Do.
A lot of you do. So do you mind kind of giving an explanation of what that is, and then if somebody's kind of sitting on the sideline and they're like, oh, like that's worth a conversation. What does that conversation look like, and how do they reach out to you for that?
Absolutely, be glad to have that conversation with anybody who's interested in syndication. And we also have I guess I can throw in here we have a monthly meeting. Please talk about that first, actually. Yeah. Okay, I was going to say, to learn more about the syndication and multifamily in general.
Let's start with your meetup, because I know you guys have a great meetup here in Asheville as well. So
that's great. You actually have our meeting tonight, which is, this will air later.
Oh yeah,
but we have one every month. Asheville Multifamily Investor Club. You can find us on meetup.com. We're on Bigger Pockets, LinkedIn, all that. But basically, we focus on some subject. Tonight's one is like 1031 exchanges.
Okay, great.
We'll do property management. All different. We'll try to find an expert.
Right.
And then do a deep dive on a particular subject every month, and so everybody can learn from it. But everybody that wants people to come that want to do their own fourplex or eightplex, and all the way up to people that want to be a limited investor, a limited partner on a syndication deal. So we go over a lot of that stuff there as far as some of the knowledge and just getting to understand some of the terms and idiosyncrasies of the business. But basically, syndication is just a pooling of money, and typically it's under Reg D on the SEC. So there's a 506B and 506C are the two most common. The 506B is mostly what we do, and that takes you're basically an accredited investor.
Okay.
At that point, and if you want a quick definition of accreditation,
please, yeah.
So accreditation would be if single filing, it's you make $200,000 a year or more, and you have for the last 2 years. Expect that going forward. If you file jointly, it's $300,000, or have $1 million net worth excluding your primary residence. That's just the most basic. There are some other ones that can filter in there, but those are the two most basic.
What's the thought process? I guess these are definitions or guidelines by the SEC.
There.
So do you have an idea of what the thought process is, or why is it that they have this threshold to be able to invest money, with somebody like yourself?
Exactly. Well, since they're all exemptions on that, since there's not the same vetting necessarily, they want to make sure it's and we want the same thing. We would want to take anybody's last $50,000.
You want somebody going hungry over a deal, essentially.
Right.
Yeah.
If it's their last $50,000, they really can't afford to be in it for the fact that anything can happen.
Right.
But more, if you need the money that badly, there's a good chance, and sometime in our 5-year time horizon, you need the money back, and it's not a liquid asset. It's like stocks; you can't just trade and sell it. It's you're in the partnership, right?
Yeah. So that kind of goes to my next question: is so once somebody's in a deal with you all, you guys are holding 3 to 5 years. It sounds like then either refinancing out or selling, or is that accurate? Or
it is. Our typical hold is going to be 5 years.
Okay.
We'll renovate the first couple, stabilize it, enjoy some of the cash flow, and then we're always watching the market, of course.
Yeah.
If it makes sense to sell it 3.5 years, we will. If we happen to 5 years, it happens to the economy's taking a dip and the prices are low, we'll hold a couple more years till it comes back. We're not on like some funds are on dead calendar timelines.
Right.
They have to sell no matter what at this point. So we try to be a little more opportunistic with our timing.
Mm-hmm.
Yeah.
When you guys are selling, who is it that's buying these? Are these like not? I don't know. I was gonna say smaller people like you, but I don't know if that's a fair definition. I was thinking like, are you guys selling to like hedge funds who need smaller returns because they've got more money to put to work, or have you found there to be a consistent type of buyer at that 5-year mark? Because like, what value add can they have since you've already, I'm thinking of a house. You buy a house, you fix it up, you flip. You're typically not selling a rehabbed house to an investor. It's going to be to an end user.
Right, and so if you've done all the renovations, there's several different exit strategies on this. So one of the exit strategies, we do 100% of the renovations. We fix up all the units, raise the rents, and then take our gain from there. And in that case, it'd be more of a fund. If it's be a B plus, A minus asset, then different funds will buy those and they'll hold them, and they're just going to hold them for the cash flow.
Yeah.
They don't mind 10% 8% return, 8% return. That's all that. But it's a nice, stable, good part of town, cash flowing asset. There's no
they don't have to worry about it. Yeah.
Right. It's very passive for them. Our point is more going to be the other side of that, I guess, is you can do like 50% renovations. We've proven a model, and then we can sell it to somebody else from the value add, and they can say, okay, here's our path to higher NOI. We'll buy it, we'll finish the renovations, and we'll fix up the clubhouse. The little things they can add their stamp to, and they can still, because like I said, it's all based off the exit prices, off the the net operating income. And it's a huge magnifier. I mean, when you take it, so like in our current property, that we just closed on in September, there's 216 units, and you basically, if you take a $100 rent premium and you times it 216 times 12, and you take that and divide it back out by the current cap in that area is probably 6.5, the capitalization rate, it comes up to close to $4 million in value you've created in the property. If it's 125, you're close to $5 million property. I mean, so you have little things like that you can turn into big things on the back end.
Because it's economy of scale, as you mentioned a couple of times, right? So, just wrapping up a little bit, I guess. What's the first step for somebody who's interested to get started besides calling you?
Right, just to get educated. I would, like I said, I'm a huge fan of reading audiobooks, podcasts. Learn all you can on it, and then go to groups. I mean, not to promote our own, but I mean ours, but more national ones also. Like Joe Fairless has a great one. The real estate guys have great events. Jake and Gino have great events. So
it's not hard to find them if you're intently looking, right?
Exactly, yeah. You'll be surprised. And people are, I guess what I'd add to that is people are amazingly, that I've found are amazingly helpful. It's not the big small pie kind of theory, like there's enough out here that if I give you ideas or advice, it's not, I'm going to lose all my deals from that point forward, right? So everybody's been really helpful. I mean, people at a much higher level, I've been surprised when we first started out, were more than willing to, bounce ideas off of or give us advice. And it's been great. And we try to do the same thing now going forward to try to share that.
Awesome. And there's two ways, I guess, to get involved, right? You can be somebody who goes kind of boots on the ground, take your approach where you're out finding the deals, underwriting them, et cetera. Or you can be somebody who's just wanting to be, I think you used the word limited partner, right?
That's correct.
Somebody who's just giving you all the money, helping you fund the deal, and they just wait for 5 years and enjoy the returns in the process. So if you're in that group, how, what's the first step? I guess it's probably simpler, make sure you're an accredited investor, and then just talk to a couple of people, talk to you, and then make a decision, or?
Right, absolutely. Like on our website, with Park Capital Partners LLC.com, there's links on there. You can schedule, you fill out a little application. We'll be glad to have a conversation with you, because we want to find out if it's a right fit.
Right.
We don't want everybody's, to invest. It's not right for everybody. But if it's right for you and you like our strategy, you basically just have to and under that 506B, you have to have a pre-existing relationship. So we have to have a call first. We have to, have a few conversations to, again, know if it's a right fit. 506C is the one you can kind of advertise on Facebook, LinkedIn, and it's different, a little different accreditation on that side of it. But we want to have more personal, because we want them to be, long-term investors.
Yeah,
there's nothing better than
15 years of a relationship or whatever. Right?
And that builds, and they'll tell their friends. I mean, it's a good model for our business. It's very personal.
Yeah, no, that makes sense. And just curious on that. As I mentioned at the beginning, so if you got funds in an IRA, you're able to invest in a syndicated group through self-directed IRA accounts. Is
That's correct.
Okay.
Yes.
So if you got money laying around in a 401k as well, I'm assuming, right? Any self-directed type of account?
Yeah, absolutely.
That's awesome.
And it typically, what they look for in our returns are looking, like if you're looking at B properties, like a 15-16% internal rate of return, IRR, which is probably. It's close to a 2x equity multiplier at the exit. And that's, typically most in this business will pay like a 7-8% preferred return, and then quarterly or monthly, depending on how it's set up. And then at the end, you'll get, the 70-30 split. Typically, the limited investor will get like 70% of the upside. The general partners are the managers, the people who run the deal, right? And the limited partners are passive. Once they put their money in, they just they get
just be patient.
Yeah, they get a monthly update, a quarterly check, and then it's kind of just it's definitely, so for busy professionals, it's a great thing. There's
great
no
option.
hands-on. You don't have to continue to work, and just vet your sponsors up front and
off you go. So last question for you is, curious to know, anybody who's getting into real estate, they're always like, well, what have you learned? So it's just two questions, like maybe what's the biggest lesson you've learned over and it can be single family, multifamily, anything, and then maybe what's been your favorite thing since you've made the transition to multifamily?
But I said what I would learned, I guess, is, and I've mentioned many times, enjoy studying, enjoy learning, and so the build up to that point, did a lot of research, and from the other flying job, we're used to memorizing large manuals. So it's never never a problem with that. But I was amazed after closing on it what you didn't know. I mean, it wasn't anything magical, but until you've been through it, there's definitely on the other side. There's a lot of things that you just on a daily basis have to run through and solve. It's not like rocket science or anything, but it definitely exponentially increases your learning curve once you're actually in the heart of that in the deal.
Absolutely. Cool. Well, Bill, thank you so much.
Absolutely.
And as a reminder, guys, if you're interested in getting plugged in, is it the first? What's this? Last Wednesday? Today's today's Thursday. So last Thursday of every month, or
meetup.com. It's Tuesday or Thursday. We'll vary sometimes on my schedule.
Okay. Yeah. So meetup.com, Asheville Multifamily Club, and then Park Capital Partners LLC.com. If you have any questions about getting involved in syndication. Awesome. Well, Bill, thank you so much for joining us on the show.
Absolutely, Rodrigo. Appreciate it. Thank you.
Absolutely. And everybody else, thanks for tuning in. As a reminder, we'll be here every Tuesday, so see you all next week. And also, please give us a review, rating, iTunes, Facebook. I guess you can do that as well. Anywhere you listen to the show will be much appreciated. And we have a meetup first Wednesday of every month over at Archetype Ruin. So if you're interested just general real estate, see you all there. Till next Tuesday. See you.